Picture this. You wake up on a Tuesday morning. No alarm, no boss, no hustle. And before you even pour your first coffee, your phone buzzes. Dividend payment received. That's $5,000 hitting your account this month. Not from working overtime, not from selling anything, just from money you already put to work. Sound unrealistic? It's not. Thousands of people are already doing it. And in this video, I'm going to show Alex and you exactly 3 ways to get there, starting from almost nothing. Before we get into the strategies, let's make sure we're on the same page about what a dividend actually is, because most people overcomplicate it. When you buy a stock, you're buying a tiny ownership stake in a real company, a company that sells real products, makes real money. When that company earns more than it needs to keep running, it has a choice: reinvest the profits or share them with its owners. When it shares them, that payment is called a dividend. Alex owns shares. Company pays dividends. Alex gets cash deposited straight into his brokerage account. Now, the key number you need to understand is dividend yield. It tells you how much income an investment pays relative to its price. A $100 stock paying $5 per year has a 5% yield. Simple. This number is how we compare every single strategy in today's video. To reach $5,000 a month, that's $60,000 a year, there's no single right path. There are 3, and each one makes a different trade-off between safety, speed, and income. Path 1 is the safest. It takes the longest, but builds the strongest foundation. Path 2 is the middle ground. Higher yield, shorter timeline, a bit more exposure to market cycles. And Path 3? That's the fast lane. Highest income, fastest results, but with real trade-offs you need to understand. Let's start at the foundation. Strategy 1. The Dividend Aristocrats portfolio. This is built for one thing: reliability. Dividend Aristocrats are companies that have raised their dividend every single year for at least 25 consecutive years. Think about what that means. Through recessions, crashes, pandemics, these companies kept paying and kept growing their payout. That's the kind of staying power you want at the foundation of your portfolio. For Alex's portfolio, we're using 3 holdings that work together as a unit. First, Johnson & Johnson J&J, a healthcare giant with a current dividend yield of approximately 3.1% and a 10-year dividend growth rate of around 6.3%. Incredibly stable, defensive business. People need medicine regardless of the economy. Second, Procter & Gamble PG, consumer goods powerhouse with a dividend yield near 2.4% and 10-year dividend growth rate of about 5.8%. This is the definition of a sleep well at night holding. Third, Schwab U.S. Dividend Equity ETF SCHD. This ETF spreads Alex's investment across dozens of quality dividend payers. SCHD offers a yield of approximately 3.6% with a 10-year dividend growth rate near 10.6% and annual price appreciation averaging around 9%. Combined, this portfolio yields roughly 3.03%, with dividend growth near 7.6% and price appreciation averaging about 8.5% per year. Now here's the math. To pull $5,000 a month, $60,000 per year, from day one at a 3.03% yield, you'd need around $1.98 million invested up front. Most people don't have that. So instead, Alex starts with $25,000 and adds $10 per day, about $3,650 per year, reinvesting every dividend. Under these projections, the portfolio reaches the $5,000 per month income target in approximately year 28. Slow? Yes, but rock solid. And the compound growth underneath that income is genuinely powerful. Strategy 2. The REIT portfolio. REITs, real estate investment trusts, are companies that own income-producing real estate. Warehouses, shopping centers, healthcare facilities, billboards. By law, they must pay out at least 90% of their taxable income as dividends. That's why their yields are much higher than typical stocks. For Alex, this middle ground portfolio uses 3 REITs with different roles. First, Realty Income Corporation, known as the monthly dividend company, and they mean it. Realty Income pays monthly dividends, currently yielding around 5.8%, with 10-year dividend growth of approximately 3.5% and steady price appreciation. Second, Vici Properties, Vici. This REIT owns casino and entertainment real estate. Think MGM Grand and Caesars Palace. Vici currently yields approximately 5.5% with an impressive dividend growth track record and strong cash flows tied to long-term triple net leases. Third, Agree Realty ADC, a retail-focused REIT with a dividend yield near 4.1% and consistent dividend growth. ADC focuses on top-tier tenants like Dollar General, Walmart, and AutoZone, making cash flows extremely resilient. Combined, this REIT portfolio yields approximately 5.13%, with dividend growth averaging near 7% and price appreciation of about 5 to 6% annually. The math: at 5.13%, Alex would need around $1.17 million upfront to generate $5,000 per month immediately. But with the same $25,000 start and $10 per day additions with dividends reinvested, this portfolio is projected to cross the $5,000 per month income target in approximately year 18 to 19, nearly 10 years faster than the Aristocrats' path. The trade-off? More sensitivity to interest rate changes and economic cycles. But the income payoff is real. Strategy 3. The Covered Call ETF portfolio. This is the income machine. Covered Call ETFs are built with one primary mission: generate cash flow as fast as possible. They do it by combining stock ownership with a strategy called selling covered calls. Here's the simple version. The ETF owns stocks. Then it sells the right to someone else to buy those stocks later at a set price. The buyer pays a premium for that right up front, regardless of what happens next. The ETF keeps that cash and pays it to investors as income. The result? Yields that blow traditional dividends out of the water. For Alex's high-income portfolio, we're using 3 powerful covered call ETFs. First, JP Morgan Nasdaq Equity Premium Income ETF JPQ, focused on large-cap technology stocks. JPQ currently offers a dividend yield near 10.3% with meaningful dividend growth and strong underlying tech exposure. Second, Global X S&P 500 Covered Call and Growth ETF XYLG, a blend of covered call income and some price growth participation. Yield approximately 7.5%, offering a more balanced approach than pure covered call funds. Third, Yield Max Ultra Option Income Strategy ETF ULTY, an aggressive, high-distribution vehicle currently yielding above 12%. This one is for income seekers who understand the risks. Price appreciation is very limited, but the cash flow is extraordinary. Combined, this portfolio yields approximately 9.93%, with dividend income growing significantly, though price appreciation is minimal. Here's the game-changing math. At 9.93% yield, Alex would need only around $604,000 to generate $60,000 per year in dividends right away. With $25,000 to start and $10 per day contributions, this portfolio is projected to cross the $5,000 per month target in approximately year 11, nearly 7 years faster than REITs and roughly 17 years faster than Dividend Aristocrats. The trade-off is clear though. You're giving up price growth for income. This strategy works best when you're in income extraction mode, not wealth accumulation mode, which is exactly why it sits last in this plan. So let's line all 3 up side by side. Dividend Aristocrats, lowest yield, most stability, longest timeline, reaching $5,000 per month in about 28 years. Your money grows slowly and predictably, like a river carving through rock. REITs, medium yield, medium risk, real estate-backed income, reaching the target in roughly 18 to 19 years, about 10 years faster. Covered call ETFs, maximum income, minimum price growth, fastest path, reaching $5,000 per month in just about 11 years, a full 17 years faster than starting with Aristocrats alone. Same goal, 3 different roads. The path you choose depends on your timeline, your risk tolerance, and where you are right now. All 3 paths work. The question is, which one fits your life? If you want to go even deeper and see how to build a real dividend portfolio starting with just $25 a week, click the video on screen right now. I break down every single step, and it might be the most important video you watch this year.